Your time's valuable. We really appreciate your joining us. We want to make sure that you get the most out of what we are sharing here. And the purpose of this Microcap Masterclass is to share a unique investment approach that we believe has the power to change the way you invest forever. And if that sounds like a bold statement, consider this. The principles and strategies that you'll hear about over the next 45 minutes or so have been used by many of our most successful investors here at the Motley Fool for nearly 25 years now. And they have consistently helped us lead investors like you directly to some of the market's smallest and most under-the-radar stocks. That's right, because unlike many other microcap approaches that rely almost entirely on luck or betting on worthless penny stocks, the strategy that we are so excited to discuss with you today is a time-tested approach that the Motley Fool has used to identify and invest in some of the market's greatest small and microcap stocks before they became household names. I'm talking about stocks like Netflix, Shopify, Middleby, MercadoLibre, Zillow, Activision Blizzard, and many more. So before we get into all of that, please allow me to introduce the rest of the team joining me here in the studio. At the other end of the table, the co-founder and the CEO of the Motley Fool and the organizer of today's event, Tom Gardner. Next to him, Bill Mann, our director of small cap strategy. And immediately next to me, our Chief Investment Officer, Andy Cross. It's a full house. Thanks for being here, guys.
Let's do this.
Before I kick it over to Tom, please remember that given the nature of the companies that we're going to be discussing here today, we are only offering access to this event through midnight tonight. And after today, a replay of this event will not be available. So please, we encourage you to turn off any distractions, turn off the cell phone, the TV, get comfortable. We know you're busy, and we really appreciate your taking some time to be with us. Get a chance to maybe take some notes. We want you to be able to enjoy the full discussion that we have in store for you. Last but not least, throughout the event, if you lose connection, you have any sort of video freeze-up issues, please just try to refresh the page. That usually does the trick. With that, Tom, we're going to get into a lot of the specifics around small and microcap investing, as well as the Rising Stars portfolio, the real money microcap portfolio that you and the team manage here at the Fool. But I wanted to start by talking a little bit about the broader market that we're in these days and what investors need to be thinking about on a macro level.
Well, first of all, I'm thankful you mentioned taking notes, because the spirit of today's gathering is to make sure that everyone who's out there, every fool who's watching, gets a lot smarter about small cap investing and micro cap investing, because it's the best performing area of the market historically. Yet when you talk about somebody who's working with a financial advisor, a broker at the big firms, they generally shy away from these companies. And so that creates a really great market opportunity for investors like us. So a year ago, we came forward and said, hey, small caps have underperformed large caps over the last decade, and that's highly unusual because historically, small caps have beaten large caps by a couple percentage points a year. So that startled us. It seemed like, wow, there's so much capital going into index funds. The Vanguard organization, which we're extreme admirers of and have been since inception at the Motley Fool, is vacuuming up a lot of capital index funds, and their capitalization weighted. So that money is going into Facebook and Apple and Netflix and Google and Amazon, and those businesses are there's a concentration of wealth in those companies, and that's leaving behind a lot of other businesses. Now, some of those businesses left behind we shouldn't be investing in. But when we're talking about very well-run small companies, wow, we're getting discounts. And as long as we have a great long-term time horizon, as we always do at the Motley Fool, we've got the chance for some remarkable returns, and we've demonstrated that in year one.
Yeah, Bill, it's interesting, as Tom mentioned, I mean, one of the big stories over the last 3 to 5 years in the investing world really has been that rise in passive investing.
Yeah, and it has really driven some concentration at the top with the S&P 500, which is, as Tom said, a wonderful instrument to invest in. Now those 5 big companies, the FANG stocks, account for about 16% of the S&P 500 by market cap. The bottom 283 companies in the S&P 500 are another 16%, so they are of the same size. So what we're suggesting, and I think that that research has borne this out, is that we're getting the opportunity to go to a place where it's really, really hard to do as a passive investor.
Andy, it's pretty incredible when you think about the FANG stocks,
Yeah.
because these are companies, when you think about Facebook, Apple, Amazon, Netflix, Google, now Alphabet, these are companies that we've followed for years. We're admirers of the businesses and the leadership. And for a lot of investors, you do fine just investing in those over the past 5 years.
Well, you've done very well. I mean, if you just think about the economic effects and impact these businesses have nowadays is much higher than it was 10 years ago, or even 5 years ago. So the fact that they've done well as stocks shouldn't surprise anybody. But I think what we're talking about here is really the concentration, and whether you look at the flow away from actively managed mutual funds and into passively managed mutual funds, which has gone basically the opposite directions over the last 5 years. And the fact that you have all this concentration into really a few names, as Bill mentioned, that really leaves an investing opportunity to go where others aren't fishing, to fish where others aren't fishing. And that's really the smaller size of the market, which, as Tom mentioned, historically has outperformed the larger brethren. So when we looked at where we thought the best opportunity was, Chris, we saw the small and microcap market as a place where we know most investors, individual investors, lack exposure to. Most of them have exposure to the larger size of the markets, whether it's through mutual funds or whether it's through their own individual stock selection. And in the smaller size, where they should have some exposure and it should have a percentage of their portfolio, they lack that investing involvement. We wanted to change that.
It has been a very long time since there was this much concentration in a few large companies in terms of the capitalization of those businesses. I mean, you go back to 2000, and that was an indicator that there were going to be problems in the market, because there was such a focus at that point on AOL, Yahoo, Cisco, Intel, Microsoft. That was where, and a lot of other companies that don't even exist anymore. And so we have that big concentration. And we're not here to say today, nor have we said at any point during the last year, you shouldn't own Facebook. That's my largest holding. You shouldn't own Microsoft. By the way, Microsoft should be in the FANG stocks. It should be like Fang'em, because Microsoft is such an awesome company, and under their relatively new CEO, what a great performing business it is. It's just that it can't be true that the world is going to be dominated and double and double and double again the value of these businesses. There are thousands of companies listed in the U.S. markets, and they're being left behind, and they're run by some awesome entrepreneurs who are putting up great cash flow numbers, great growth numbers, but their valuation doesn't show it.
Well, when we talk about the concentration in the FANG stocks, obviously we're talking about the amount of money invested. But to your point about these stocks being left behind, Tom, we could also be talking about the concentration of attention from Wall Street analysts. I mean, that's really where the opportunity lies for investors right now. It's because there are so many Wall Street analysts who are covering the FANG stocks, and there are all these smaller companies that really just aren't getting any attention at all.
The economic model on Wall Street and in financial services industry across the world does not reward or gain any benefit from covering smaller companies. Remember that these large banks and investment banks often have multiple relationships with large companies, and so they're covering the big business, and they're hoping they're going to do a refinancing or some debt offering or something connected to that investment bank. So why are they going to cover a company with a market cap of $700 million? There's just no reason. And so these companies have very little analyst coverage. There's no one following them. And then let's look at the media, and let's look at what's happening in the world on the internet, which is there's a lot of clickbait out there. There's a lot of like shock headlines, and if you put a shock headline about an unknown small cap, nobody's clicking it.
Nobody's shocked.
So there's no one's shocked. So the general public is not reading about these companies. As Steve Jobs said, real innovation in the software industry happens with small software companies. So you're seeing computational power multiplying with great small tech companies that we've been investing in here in the last year, 2 years, 3 years, 4 years, and we think they still have a lot of room to run here over the next 10 years. So I just think there are a lot of forces that are aligning around large companies, leaving behind in the auction market all this great merchandise that we can bid on when no one else is bidding.
And the really interesting thing is that in the last year, there have been some regulatory changes within Wall Street, specifically in Europe, but it's happening everywhere, that changes how Wall Street firms can even interact with their clients. They have to be able to pay for conferences, for research, and things of that nature. So the things that Tom's talking about, it's only going to get worse. It's only going to be more concentration on the top 20 companies than there are even today.
Yeah, and the final point I'll make is just when you think about the private equity market and you think about the IPO market, there's so much money tied into the private markets that when these companies come public, I mean, Bill, when we were working in Hidden Gems, our small cap service many, many years ago, the concept of a unicorn was still like a fairy tale. And now the concept of a unicorn is actually a company that's valuation at more than $1 billion. And you see these massive, massive size of unicorns coming out, that there's the money coming out into the markets is not where the small cap, microcap investor that we think has a real advantage is actually concentrated. So the fact that in the public markets you can go into and you can find these really well-run, growth-oriented companies at less than $1 billion in market cap capitalization is really attractive because the rest of the investing base is not looking there.
Well, I'm glad you mentioned the small cap service that you guys used to run, because that, to me, is one more reason investors should be looking at this space, is because the track record that you guys built up over the past decade investing in these types of companies has been a tremendous outperformer.
Well, it shouldn't surprise us. Again, for all the reasons that we've shared, that it's an uncovered area in the market. And so if you're doing business analysis, it's not technical analysis, it's not trading, it's not trying to figure out whether there's going to be an earnings pop next quarter. When you're doing business analysis and you're looking 5+ years forward, after all, when you find great leadership teams of small companies, they're not really worrying about the next year or two. Sure. No great small cap business manager is stressed out about the next 6 months. They have the opportunity to turn their acorn into a large oak tree over the next 10 to 20 years. So we're looking for people like Jim Sinegal or Howard Schultz early in their journey in the public markets. And these companies exist, these leaders exist. Oftentimes they have very large stakes in their business. They have a huge incentive to create value over the next 10 to 20 years. And when you start thinking long-term like that about small caps, you're going to be surprised by the 2-year return you get or the 3-year return you get. It's not where we're focused, but if you want the best 2 or 3 year return, you genuinely want that to be the great 10 to 20 year business and they're out there.
Yeah.
Is that why you created the Rising Stars portfolio last year?
You know, there are a number of reasons for it. As we mentioned, large caps outperform small caps. That's just historically an anomaly. And so that either you think that's just going to continue and there's going to be no reason for people to start new companies and companies to come public and small businesses to exist in the public markets, or you think they've just been left behind. But secondarily, I'll say, you know, Bill and Andy and Jeff Fisher and Abby, who will be joining us later, we have such a great team of business-focused investors that as we looked at that and saw, wow, these companies are undercovered. Now, there are hundreds and hundreds of them, so we need a great team. Like, we're not going to be able to excel in this area if we're only looking at 10 or 15 or 20 companies. We need to go through 300, 600 of these companies. And so as I saw our team assemble, I was like, this is a great area of the market, and we can do this research together and win. Yeah,
we're trying to fish where the fish are. Right, you think about the impacts of a lot of Wall Street focusing on the top 20 companies. It is very unlikely that we are going to have an insight about the top 20 companies that is not widely known on Wall Street and has been disseminated. But literally, when Tom's talking about the 300 companies that we've researched, in a lot of cases, we're starting with the annual report and a ticker. Right, there's no research out there that's on these companies. And you know, if you really want to be a good investor, one of the basic guidelines is that you want to look at in places of the market where there are inefficiencies. And one of the basic inefficiencies in the market is where fewer people are looking.
One of the interesting things when you do historical research on the best performing stocks over rolling 5, 10, and 20 year periods is that not all of them, but most of them are unknown. Yeah. They may still be unknown after their incredible run, but certainly when they started, you weren't familiar with that company name. When you look through the small caps that we've been recommending, and we've been crushing the market over the last 1, 3, 5 years with this type of investing, when you look at the names, ask your friends and family whether they've ever heard of Varonis Systems as an example of one of the companies. No one's heard of it. It's already doubled for us. I believe it has an excellent long-term future, but it's unknown. And again, the stock market is an auction market, so when there's great performance that no one knows about, that's a that's a wonderful place to put your money long term.
Let me take a recommendation that is probably more well known, but I would wager that there are still plenty of friends and relatives that we have that have never heard of Shopify, or couldn't really share much about what, if anything, they know about Shopify. That's a stock that's up 4 times since you recommended. What attracted you to a business like Shopify?
Well, I'll share a few things, and then Andy and Bill can jump in as well. But it's a founder-run company. The founder is young and has already communicated publicly that he plans to do this for the rest of his life. So I don't want executives that are turning over every 3 to 5 years. I don't want to guess how succession is going to go or what the new vision is. I want somebody who's there and who's passionate about this area of the business. Second, they are building the operating system for retail. I mean, just look around, drive around out there. We see the malls closing, and the malls may be the first tier. That may be the first layer of closing, but if you go around New York City now, you'll see Soho, a big shopping district, a lot of for lease signs going up in windows there, and a lot of retail locations turning into coffee shops or bars. The retail market is really starting to narrow when we think of physical space, and it's coming online. And who's the provider for the best applications for a merchant? Shopify is. So it's also a Canadian-based company, which puts a little bit off the radar. We like that. We like to see businesses that are doing very well, again, a little bit on the periphery. And as you said, Shopify has been an incredible stock. I believe in it long term, and most people still don't know about it.
Yeah, I think Shopify is just building this wonderful ecosystem on a massive growth opportunity. When you just think about still online commerce being a relatively small percentage of all total transactions around the world, Shopify reaches to consumers and to shoppers all over the world, which nobody else can really do that except maybe a few when you think about some of the big ones in China and Amazon.
I'd say Shopify is like one of the best future competitors to Amazon.
I think so too, and furthermore, Chris, the one thing throughout our history when I just go back and look at some of the success we've had, these companies have had doubters along the way. They've had some investing short attacks go against them, and just leadership teams and business models and growth opportunities and market opportunities that can transcend that doubt. And when you can invest into that doubt, Tom, I think that is just a time that we've been able to find these really wonderful long-term gainers. And I'll just add finally that the ability to hold on to these companies when you're an investor into it, which so many others in the market, when the average mutual fund, actively managed mutual fund, is churning a stock every 6 to 8 months maybe, or a portfolio in total,
and
our
individual investors are paying for all that churn.
That's right, and our holding period is at least 5 years, if not longer, and throughout history our turnover has been exceptionally low. That's the way you can find these micro and small cap businesses that end up growing into mid and large cap, and that's just a beautiful thing to see in your portfolio.
Yeah, we really look for 2 things. One is a company with growth opportunities as well as optionality, and I think Shopify has both of those in spades. Yep. And then the other thing, and Tom created this wonderful visual when we were talking about the leaders of these companies, and Tom said, why don't we think about leaders who are, as he described it, lashed to the mast of these businesses? And to me, when I think about Toby Lutke, and he is committed to. He's never even spoke about an exit strategy of selling.
I think at some point there was a rumor that Google was going to buy Shopify, and the leadership team at Shopify sent a message back out to the public markets, hey, maybe we're going to acquire Google. So, that's a little tongue-in-cheek, and by the way, they've signed some big partnerships recently between the companies. But yes, what we're looking for is a scenario like what you see at Amazon. Why is Jeff Bezos going to work? He is the sitting CEO and chairman of a public company, the largest shareholder. He's worth $150 billion.
Which is a lot.
Stock, which is quite a bit.
Quite a bit, yeah.
He's not going to work for money, but it is that type of commitment that this is their passion. As Buffett says, this is the one asset they plan to manage for their family over the next 100 years. That's what we're looking to invest in: small, unknown, well-run companies with a dedicated founder CEO.
Well, and Shopify, even if people are unfamiliar with it, just hearing this conversation, they can wrap their head around it for anyone who's ever done shopping online. But Bill, LCI Industries, formerly known as Drew Industries.
Yeah.
I mean, that's another small cap recommendation that's very much off the beaten path.
Yeah, that's a company that Tom and I have known for years. In fact, Bill Barker was the one who originally founded one of our fellow analysts, and they make equipment that goes on mobile homes and on RVs. They don't make the RVs themselves, but they make sliders, and they make the door hangers, and they make all of this equipment in a really seemingly pretty unsexy industry, but
Oh, it's unsexy. It's not seemingly unsexy.
Okay, fair enough.
That's legitimately unsexy.
An extraneous
nice
word
try
is
qualifying.
legitimate. I just didn't want to insult anyone.
It's true.
It's honest.
Yeah, and those are great capital managers. Bill and I visited their headquarters. Their offices are next to a karate gym.
was a dump.
And humorously, they were going to charge us to go to the restroom. They were joking because that's how carefully they manage their shareholder capital. So, yeah, these businesses are out there. Again, out of the thousands of public companies that are small, we're talking about the top 5%. That's what we're seeking. That's what we've been finding. And that's what we recommend people have a portion of their portfolio allocated to. Andy said this to begin, but it's important to have diversification in your portfolio. You don't want to have index funds alongside the largest technology companies and 10 of the largest companies. I mean, that's just duplication. So you get additional diversification by going where others aren't. I
want to go back to something that you said near the top, Tom, which was, look, a lot of people work with financial advisors, and just the average financial advisor, when someone goes to them and says, "Hey, I'm interested in small caps," one of the first things they're going to hear back is, "No, they're risky, a lot of volatility." And when you one of the things we've talked about before is sort of, well, yes, technically that's true, but maybe that's true for any business in the short term. Once you start to spread out that time horizon and that holding period, then it becomes almost a non-issue.
And it's quite funny because the large investment firms are not going to buy these companies for a host of reasons. Some of them, it's difficult to get a lot of capital into a small company. But as you said, it's the old saw. You don't get fired for recommending IBM technology 30 years ago. If you went off the beaten path and picked a new software company like Microsoft or like Oracle, you might risk losing your job 30 plus years ago.
These are risky for me to recommend to you.
Exactly. And so your brokers out there are not going to be recommending these type of companies. They actually sit at either extreme. Truly, the more legitimate ones are out there just recommending large caps. And when you bring a small cap idea to them, they're like, "Our firm does not think that you should do that. That looks ludicrous."
We don't cover that one.
We don't cover that one. We've had so many people tell us it's very funny. My wealth advisor will laugh at the stocks you're recommending, but you're crushing their returns. And I know that's a common experience for Motley Fools out there. At the other extreme are the penny stock promotional garbage companies that get recommended by super low quality, unethical, and in some cases illegal brokerage recommendations that go out there, as you know, from like Wolf of Wall Street. So there's a lot of associations around small companies that just look bad. The legitimate firms won't recommend them, and then there are these cheesy promotional firms. But sitting right in the middle there are these awesome companies, as we've said, and they're just sitting out there waiting for us to recommend them and to hold them for the long term.
So we've been talking about all of this data around small cap investing and how great it can be. Why aren't more people doing this? Why do you think there aren't more investors with all of the data that we've just laid out? Why aren't more people doing this?
I mean, for me, two reasons. First, there are a couple thousand companies listed in the U.S. markets that have capitalizations under $5 billion. So in order to find the best of those, right? If you look back 100 years, 4% of public companies have driven all the returns, 1 in 25. So if you're going to find the 1 in 25 out of 4,000 small cap companies, you have to do a lot of work, and that's why having a team really helps us scale across all of that, and all of our analysts at the Motley Fool helping to participate. But then I think the second reason is you need ongoing research, because there's a behavioral component to getting great returns, and smaller cap stocks are more volatile, and it's only natural if you're home alone looking at a stock and it's risen a lot or gone down a lot, you're stressing out about it. And that's one of the key components of Rising Stars and of Motley Fool experiences in general, is that we're here to make sure that our members and investors travel along with us with a great behavioral approach.
Yeah, it's funny when we talk about the historic outperformance of small caps over large caps, there is still a larger variance between the most successful small caps and the least successful small caps, much more so than large caps. There are a lot of small caps that you really want to stay away from. And so it's easier for people to say, well, I'll just stay away from the segment. It's just, it's too risky, it's volatile. Those are behaviors that, that people just aren't necessarily naturally going to gravitate towards.
Are there like automatic red flags? I don't want to spend too much time on this, but we have talked about, look, there's a lot of shady investments out there, particularly when you're talking about penny stocks. Are there any sort of like automatic flags that you just say, I'm looking at microcaps, I've seen this, and I'm staying away from it now?
Let's each give one or two.
I think one of the main ones for me is is if you pay a promoter. If you are a company, a microcap company, and you pay a promoter to try and get investor interest.
I certainly think that you want to find businesses that are growing their top line. So there may be a big story, but not much growth. So you really want to find small caps that don't have to make a lot of acquisitions early on to grow their business. There's organic growth that's playing right into it, and you need to see a great balance sheet as well. So, but there are a number of other factors. But I certainly agree with Bill. There's a lot of promotional stuff. Motley Fool Canada, like that whole country is littered with all of these oil and gas companies that are 3 people with a shovel and a lot of PR.
Maybe a shovel.
They may have purchased a shovel. So yeah, I mean, 8 or 9 out of 10 small caps that are listed in the U.S. you do not want to invest in.
I think when you look at, Tom mentioned this earlier, but like the leadership teams of these businesses, at least that we've invested in, I think the ones that have been the most successful have had leadership teams that either they were entrepreneurs and they founded the business, Chris, or they have meaningful stakes in the business, or they treat shareholders with a degree of respect that makes them one of the top management teams out there. Any small cap company, micro cap company we're looking at that we don't feel that real passion with that leadership team, we're just going to stay away from.
That's one of the main reasons that in Rising Stars we interview the CEOs. So that's a very important component. The beautiful thing about small companies is they generally are willing to take those interviews. So with us and with our company name, and so that's a real advantage for us.
Yeah, and that's stuff that you just can't open a financial statement and find. I mean,
exactly.
That sort of quality literally just comes from getting out there.
I mean, you take a company like Trade Desk that's been such a great stock, and we interviewed Jeff Green. That stock really had not performed very well for months and months. But to us, months and months, whatever, doesn't matter. Yeah. And when we talked to Jeff Green, it was so confirming of their long-term vision at that business, and it's been a great stock. I think it's going to continue to be a great stock.
So if you're going to be investing in small companies, it really does behoove you to really build a portfolio, to really balance all of that out. Because, as you mentioned, Bill, I mean, there is going to be the volatility.
Yeah.
Well, I mean, not only the volatility, but when you think about the ones that will actually do really well for you, and Tom had mentioned that in almost any portfolio, but certainly over time, when you build a portfolio over time, your winners are going to gravitate and be more and more meaningful, and your losers will just be almost a nothing, a footnote into your portfolio.
Yeah, if you put $5,000 into 20 different stocks, so you're investing $100,000, and if you've picked those businesses well, a few of those 20, 3 or 4 of them are going to drive 80% of the returns. You don't want to miss any of those, and the ones that lose 20%. 5,000 goes to 4,000. It doesn't matter if the other one goes up 10 times or 20 times in value and turns to $50,000 or $100,000. So I think that mindset is really important, and I think that it requires that you have a portfolio mindset, and that's been a key part of Rising Stars. I mean, the portfolio's up about 30% in just the first year, and some of that is because we made the call. Small caps are so undervalued relative to the rest of the market right now, but also a lot of it is the businesses that we've chosen and accepting in a portfolio structure that we're going to have a couple really big winners, and we all need to be following those businesses and make sure we have them in our portfolio.
Yeah, and there's 2 things. One is it's a numbers game, right? But the other thing is that when we went out and picked these companies, we picked 40 companies. One of the things that we talked about was this is probably the point in time in which we will know these companies the least, right? Even if you've never done any research on Apple, you could probably give me a pretty good investing case for it. Anybody could. But with a lot of small cap companies, they are unknown. And the process of getting to know them, specifically getting to know the management, really takes a lot of time past what the original recommendation is.
The spirit of Rising Stars is not my favorite analogy because I've never seen anyone do this, but to get as close to shooting fish in a barrel as possible. And so we came live with 40 recommendations, and we've reopened the service the portfolio to new members a couple times here in the last year, and each time we've narrowed the number of those 40 companies.
We've drained a little water out of the barrel.
We've drained a little water out of the barrel and gotten a better look at certain fish that we really like. And our goal is to make this we're trying to make it as easy as possible for long-term business-focused investors to find the best companies and invest alongside us.
Now, I will say, like, our pattern recognition, research, history shows, and I think just the experience we have in the way that we're thinking about these businesses, Chris, gives us the best confidence and opportunity to find these winners. Not all of them will, as Tom had mentioned. No. So right now, probably north of 2/3 of our Rising Stars companies are making money, and then a few of those are really driving a good chunk of the returns, and not very many are losing to the market. But generally, over time, we're going to find those ones, considering the way that we look at these businesses. And if an investor is willing to hold them for that time period, not just for a year, but up to 5 years, those returns will compound over time. And that is really the most wonderful way to build the business or build your portfolio.
The business of your portfolio.
Yeah, the business of your portfolio.
And I will say, if you look at our data historically at the Fool going back, it's the companies that we re-recommend. We add to that position again. We recommend Netflix, 12 years ago, 14 years ago, and then we add more 3 months or a year and a half later. Those repeat recommendations have ended up delivering market smashing returns, and that's really where we are in the Rising Stars portfolio now. We're re-upping for another time, having started a year ago. So it's our third repeat recommendation that we're excited about.
Well, and as you mentioned, Tom, Rising Stars has launched about a year ago. It's been opened to new members a couple of different times. Part of this event that we're doing right now is to share that we're opening it again. This is the last time, though.
This is it. This is Rising Stars' fourth round. We recommended 40 stocks to begin, and we have now narrowed that 40 stocks down to 14, our 14 favorite, and we're adding 6 new companies that we really believe in long term. These are all small cap companies, all capitalized under $5 billion. We believe that they have the ability. They would not have made it into this round unless we thought that they could double within 5 years. So that's a 15% annualized return. Will that happen across all of them? Of course not. But by thinking that way, we've set a very high bar, a very high standard bar on the quality of that business, but also the valuation. We run valuation on all of these companies. We look through their financials. We talk to the leadership companies throughout the year, and we've gotten to a place where we really love 14 of these companies, and we're very excited to add 6 new ones. And the returns have been great so far, and we're very excited about reopening Rising Stars' portfolio now.
Well, and it's interesting because, we're talking about this thing. Yeah, we did this a year ago. A year ago, this was very different than any Motley Fool service that had sort of come before it, because we're talking about building a portfolio, and in Rising Stars, new members are getting the portfolio all at once, right up front.
That's right, because we want to make it as convenient as possible to allocate your capital into a broadly diversified portfolio and to be able to follow those companies right along with us. And again, another thing that was unusual a year ago, Chris, and I know Andy and Bill can add more flavor to this as well, is just it was quite a contrary call. To think, wow, why don't I just go with the big winners in my portfolio?
Go with the FANG.
Go with the FANG. And you know what? We never said, and have never said, as I said earlier, we never said sell those. We just said you need another layer in your portfolio that's going to be the next generation of those awesome companies. And we're starting to see that happen.
Anyway, when we talk about Rising Stars being up 30%, I imagine a lot of people watching are like, well, have I missed it? Is it too late?
Well, yeah, I think some people may be looking at this and saying, wow, the horses are already out of the barn, and why would I jump in now with a portfolio of 30%? And that's a bad way to think about stocks and investing, especially when you're thinking about long-term investing, Chris. So the history, when I look back at some of our recommendations, some of the best recommendations we've had in our history, from Netflix to Booking.com to Amazon.com to Facebook, Tom, and a few of the others, many of the others, we've added to those even after they've run up. So we are looking at these businesses first and thinking about what is the growth opportunity, what is this leadership team going to take this business, and will that benefit the stock price? Will it be able to deliver a 2x, a double in less than 5 years or within 5 years? And not looking so much at where the price of the stock has run so far, but where it can actually go. And that's really important. And I think adding to your winners and getting in the history and the rhythm of adding to your winners is really a great practice for any individual investor.
Yeah,
to
but Andy,
follow.
let's talk about the market. When we launched Rising Stars, one of the things that we said was that small caps have underperformed large caps since 2008. So the period from 2008 to 2017, small caps badly underperformed large caps. So even though small caps are up, and we are outperforming the small cap index as well, they have not nearly come back to the point in which they would, what they would be doing historically compared to large caps. So yeah, we have a long way to go.
I think tying those 2 points together, both of which I agree with, if these were super large cap companies, maybe it is time to stop adding to them and just allow those businesses to perform for you. But with small companies, the great performance of these stocks is confirmation that these businesses are performing well. Mm-hmm. And when you have a company capitalized at $1.4 billion, let's say, or $3 billion, and their top line is growing 40 or 50%, they've got a founder who's bought in and is oftentimes a relatively young person who's got decades ahead of them, that's not the time to sell. It's also not the time to stop adding. So we wouldn't be recommending these companies if we didn't believe in them long term, and we're putting our real money behind them. We have about nearly $550,000 invested in these companies. Again, we've got a 30% return the first year. That feels great, but this wasn't a one-year portfolio with a one-year view. These are small companies that we think can compound great returns over the next 5, 10, 15 years. So we're very excited to be adding more capital and having more skin in the game right now in the Rising Stars portfolio.
All right, as we've discussed, because Tom and the team are on the verge of issuing what could be the most anticipated microcap guidance the Motley Fool has ever issued, and because, as we said, this is the last time we will ever be extending new member invitations into this exclusive service, we've put together a special VIP invitation that we're making available to members like you until midnight tonight. So before I turn it back to the guys and we keep the conversation going, I want to take just a minute to make sure that you have all the details behind this last time ever invitation and why we're so excited to reward attendees like you. Because you took the time to clear your schedule and attend today's event, we wanted to give you the chance to secure what could be the best new member invitation we have ever offered to the Motley Fool community. Starting with the fact that when you join before midnight, you will gain immediate access and be among the very first group of investors who will ever see all 20 microcap stocks Tom and the team will be revealing exclusively to members of the Rising Stars portfolio tomorrow, July 26th. When you join the Rising Stars portfolio before it closes its doors to new members forever, you'll receive detailed buy reports on all 20 stocks, specific allocation guidance on every holding so you know exactly how to fit these stocks into your portfolio, and you'll get the chance to interact with Tom, Bill, Andy, and the other Rising Stars investors inside of our tight-knit members-only community. Even better, joining today also guarantees you receive a $1,000 discount, and you'll lock in the lowest price we've ever offered for this special VIP invitation. Only when you join before midnight, you'll pay a one-time fee of just $3,999, a fee which entitles you to access for the entire lifetime of this service. That's right, you will never pay another dime, no ongoing membership dues, just a one-time fee, and you're set. Now, while grabbing our lowest price and guaranteeing your access to the team's latest guidance is great, here's what I think makes today's offer really special. For investors who join before tonight's deadline, Tom has agreed to also give you full access to his everlasting portfolio service at no additional cost. A one-of-a-kind portfolio that contains the only publicly traded stocks that Tom personally owns and the only publicly traded stocks he will buy for the rest of his life. Securing this complimentary access to the everlasting portfolio will show you how exactly Tom incorporates all the research you heard about today and more into his own personal portfolio.
And Chris, I'll just jump in and say how important that is to me for those of you interested in the Rising Stars portfolio, because you're going to get another layer of confirmation around some of these businesses. Of course, we believe in all the companies in the Rising Stars portfolio, and then in the Everlasting portfolio, some of them make their way into that portfolio as well. And just to give the story of one company in the Everlasting portfolio, one that we're all familiar with, Facebook. This is a company that before it came public, I told Everlasting portfolio members, we will be buying Facebook. This has all of the criteria that I look for. Then it came public with a lot of fanfare. The stock was around 50. $150 on the first trading day, and we waited and we started buying it below $25 a share, and then we've been adding all the way up. Here it is at 210. It's my largest position in the Everlasting portfolio. And so I think what's important for members to know is that there's continuity of principles across these portfolios, and there's a lot of capital in the Everlasting portfolio that can help people see how we're allocating the money behind our favorite businesses. So I'm excited to have Rising Stars portfolio members who purchased today join us in the Everlasting portfolio as well.
And just a few months ago, we charged $2,999 for 1 year of access to the Everlasting portfolio. But until midnight, it is included in your VIP invitation at no additional cost. So as you can see, we've done our best to make sure our Rising Stars members are taken care of, which is why we really encourage you to take advantage of this offer and sign up before tonight's big deadline. And if everything we've just laid out is not reason enough to grab this special offer while it lasts, please remember, not only is this brief new member acceptance window your last chance to ever join the Rising Stars portfolio, but once the clock strikes midnight tonight, the cost of this offer will increase by $1,000. So given what's at stake, you can see why we really encourage you to take advantage of this offer and sign up before tonight ends. So please don't risk getting left on the outside. If you're ready to get started and claim this special offer, all you need to do is click the green button below and complete our secure sign-up process. Additionally, once you click the button below, you'll also be given the chance to call us to complete your order. Our member services team is standing by ready until 10 p.m. Eastern tonight to take orders if you would rather talk to someone over the phone. And if you don't get through right away, please don't hang up. I promise we will get to your call. But again, just click the green button directly below this video player and you'll be taken to our secure sign-up page. Tom, before we address some of the most common questions that we hear from new members of the Rising Stars portfolio, I know you have another big announcement that you're making for the first time as part of this event.
Well, this is for members who have a tremendous enthusiasm for learning, for gaining more mastery, and ensuring that they have the very best stocks for their portfolio set up. And that is, we're launching the Inner Circle today for the first time ever, and that's going to include some really interesting features, and I'll just mention a few of them now. By becoming an Inner Circle member, you will thereby purchase the next 3 Discovery offerings that we have. Discovery Rising Stars is our small cap offering. It's performed very well. Our next 3, I'll give you the themes of each of them. We've never done them before at the Motley Fool, which is incredibly exciting for us. The first is a focus on pricing power. This is Warren Buffett's #1 principle. He looked back through all of his investments over his entire life and found the best performing stocks in his portfolio, Berkshire, generating 20% a year indefinitely, were companies that have pricing power. And that's very hard to do that research on your own. And we as a team will be coming together and selecting our favorite 24 companies that have sustained pricing power going forward that we really believe in. The second is IPOs, really reviewing and looking at the fresh new arrivals to the public markets. And that's where so much of the great innovation is happening in the marketplace. Rather than buying the retread large cap that you think will have a little bounce, how about buying into the future of great businesses? And then the third, and maybe the most exciting, and I love those first two, is a long short portfolio. So we'll begin to help you structure a hedged portfolio so you have the great gains that we've been able to generate 25 years running at the Motley Fool, but also the ability to short some of the companies in decline and profit from them, but also have a hedge so that when the market turns down, you have an opportunity to actually profit from that. So those are the new themes of Rising Stars when you choose to buy into the Inner Circle. And then the last thing I'll say is there are some awesome features that come to the Inner Circle members. First is the launch of Motley Fool University. Each month we will have a course with CEOs and money managers and thought leaders joining our team and going through some of the highest priorities and where to invest and how to structure your portfolio. The second thing is we will rank all of the stocks recommended across our Discovery services, and there are a handful of them. So you will see the full ranking of our stocks top to bottom every quarter, and that's really exciting. And then finally, we'll be launching for the first time ever in Motley Fool history our market read, our market indicators, our system of just reviewing. Now, we're not market timers, as you know, but you can get a good read on valuation. Warren Buffett has done it for decades. There are a number of factors you can look at, and a key factor that I've used here over the last almost 10 years that's been very effective in trying to determine, is this a good time to be adding more money? Should you do so in sort of a prudent way, or should you not be adding new money to your stock portfolio now? And so that market indicator system will be part of the inner circle as well.
Let's get to some of the questions that we get from new members. And first, right off the bat, has to do with portfolio. When people are looking at their own portfolio, it's natural, Andy, to ask, like, well, how much of my portfolio should I be putting into Rising Stars?
Yeah, so I think for an offering like this, you mostly have a portfolio that is somewhere in the six-figure range. I mean, like across all of your investment vehicles on your stock and equity side, that's probably where someone could benefit the most from the service like this. You don't have to be, especially if you have a very, very long time horizon. You can be a little bit shorter.
And if you're adding new money.
And if you're adding new money, which we do here in Rising Stars and doing some of our other services as well too. That's a very important point. So, how much of that you allocate into specifically into Rising Stars is really kind of more a personal behavior, a personal flavor of yours, especially depending on how much risk tolerance you can take. We mentioned a little bit; these will be a little bit more volatile than your large cap stocks. That's why we want you buying a lot of them, Tom. We don't want you just buying just a handful of them. We actually want you buying.
We got 20 of the recommendations, and we want you to come in and buy them all.
That's right.
Us.
We really encourage that to go in there and buy, and that's why you need to have the capital to do that.
In terms of that aspect of it, like we encourage people to buy all 20, is that right away? Because that's another question we get often is just around timing. Like, hey, 20 stocks, I'm going to get them all at once. I want to sift through the research and sort of feel comfortable with that. Should I just be clicking the buy button right away?
If you want to follow us most closely, I would get them as soon as you can. Now, there are plenty of arguments why you might not want to do that. A lot of people who are longtime Motley Fool members, they love the research and they love getting to know their companies. And then there are people who also have, financial reasons why they might not be able to get into all of them at once. You're absolutely fine if you have to or want to take your time, but it's really our guidance that you get in as soon as you can.
I agree. I think if you're going to run a very concentrated portfolio of just 10 or 12 stocks, you really have to have been, I think, working in business, reading financial statements, and investing for a very long time successfully. And that's great. But for a lot of us, not only do you still get awesome returns by having a broadly diversified portfolio, but you learn more about the world, right? You're getting exposed to more categories and more industries. So I think purchasing 20 stocks, there's a fun little secret that we launched in Rising Stars a year ago, and I'll share it with everyone now, and that is that we encouraged our members to negotiate their brokerage fees down. And something remarkable has happened. In our survey data, about a third of members have successfully negotiated their brokerage fees down, and that's.
But almost all of the people who tried did.
Exactly.
Right?
Some people didn't even go for it. But listen, particularly if you have a larger portfolio, if your portfolio is north of $50,000, it's questionable whether you should be paying anything in brokerage fees at this point. There are enough ways that these firms can make money on your account. So that there are members that have gotten 500 free trades by asking, and once you have that, buying 20 stocks, as we're recommending you do, is just smart. You're getting diversification, you're getting exposure to companies you're going to learn from. We believe in all 20 of these businesses, and it's not going to cost you very much to do so.
So we were talking about sort of this is the type of portfolio. Obviously, the longer the time horizon, you're better. At the other end of the spectrum, I can imagine, particularly older investors or people who are retired looking at this saying, well, I'm kind of interested, but is this right for me? Is there sort of like almost like a minimum time horizon that people should be thinking about with this portfolio?
Great question. I would say 3 years would be a minimum that I would want for anyone to be exposed to the stock market, period. Yeah. And then as you look out 5 years, 7 years, 10 years, that's where the real wealth gets created for investors. And so, there are investors. I remember a wonderful interview with an investor who was 103 years old who said, hey, I've been making money as a long-term investor, and I'm not changing at the age of 103. In this person's case, he went on to say, look, that's what helps me find the best companies, number one. And number two, I'm investing for the next generations in my family and for charity that I'm planning to give away. So I don't think it ever makes sense, no matter where somebody is in their life, to say, my situation calls for trying to speculate and get the best 1 to 2 year return. So I'd say a minimum of 3 years, and ideally, you're thinking 5 to 10 to 15 years forward. And my dad's in his 80s. That's how he thinks and that's how he invests. And I recommend it. Everyone does that. And same thing with Buffett. I mean, Buffett's not becoming a day trader because he's in his 80s.
Right. I will also say this is a very tax-friendly portfolio as well too, because since we're holding these positions for so long, which is rare in investing these days. So you just think about the tax benefits, just to compound those returns without having to pay taxes is a real benefit to anyone, any investor, but particularly those who may be in the higher income brackets.
I think I would say that if you feel like your time horizons are shorter, you should actually think about making this a smaller percentage of your overall portfolio.
Before we get final comments from Bill and Andy, because we're going to be bringing in Jeff Fisher and Abby Mallon in just a moment, I just want to reiterate everything we've laid out in terms of the offer, particularly if you're interested. The value proposition before midnight tonight is really incredible, particularly when you add in the access to the Everlasting portfolio, which again, we had sold that for $2,999. So if you're interested, just go ahead and click the button below the video. Let's keep this moving, though. Bill Mann, final thoughts before we say goodbye to you and Andy?
A lot of people talk about how the market has done very well over the last 10 years, and it really has been the case. But in a lot of ways, that has been concentrated in the largest 10 stocks. So when we talk about how the market is and where market valuations are, keep in mind that what you're really talking about is how 5 to 10 historically great companies have done over that time period. And just remember that when you buy a stock, you're not necessarily buying the market at all. And we see so much opportunity in small caps.
And in our mind, when you buy that stock, you're buying a part of that business. It's been a true Motley Fool axiom for many, many years, and it's so true here. We call this Discovery Rising Stars and Discoveries because we're on a journey of investing. And when I look across these 14 businesses plus the 6 new ones plus the other 20 that we have, or the other few that we have in the existing portfolio, these are all businesses that we have a lot of fun studying and learning from, talking to the CEOs, talking to executives and people who work there. We are on this discovery of learning, and we think that's just a fun way to invest, and frankly the best way to invest if you were investing in the small cap and microcap market. And these businesses are really fun to understand and learn. They're diversified. They're across lots of different industries and different products and different leadership teams. So I just look at this bucket of companies, and it's just a fun way to think about building a portfolio.
And these are the highest conviction companies that we have sitting out in the world of small caps. And I'll just add, I have the highest conviction around this team. And as Bill and Andy walk off, and Jeff and Abby, two unbelievable investors at our company, join, I'll just close by asking you, how long have you been at the Fool?
I'll be 21 years this fall for me.
Let me do my math. 19 years in August.
So, yeah. And we started 25 years ago. Yeah. So we together have been working through essentially 5 undergraduate college degrees that time period together. So
one on my, on some people's.
That's so good. And we've gotten to know each other, and we've gotten to learn where our strengths are and how to collaborate and combine them. And I just think this is the best research that we've ever done. And I'm very excited to be welcoming new members. And thank you both for all the great work you've done.
Thanks, Tom.
Thanks, Tom.
Yeah.
Tom, we were talking earlier about the Hidden Gems team, you and Bill Mann and Andy Cross, but for the Rising Stars team, you expanded the team to include the 2 people sitting at the table now.
Yes, we started a year ago, Bill, Andy, and me, and the 3 of us working on it. But there are so many companies to research, and we've got 2 great investors here on my left that have demonstrated awesome results. Jeff for a couple decades, Abby for, how long have you been at the Fool now, Abby?
3 years officially.
3 years. And last time we gathered for a discovery opening, we did what we're about to do now, which is that we trotted out a single company that is in the portfolio that we wanted to give away as a thank you for everyone who's been participating in this event. And whether you choose to join Rising Stars or not, and obviously we hope you do, we think it'll be well worth your while, we wanted to give you a little gift for being here with us, and that's to unveil a single company. Last time we did this, Abby's company that she had brought to the team was the one that we shared with everyone, and that company's up 40% since. So I feel pretty good about sharing something here. And which company did the 2 of you select to bring to the table?
Sure, Abby, should I start?
Yeah, go ahead, kick it off.
Okay, it's Five9. We purposely chose a company that we believe most people may not recognize. It's only in the Rising Stars portfolio across the whole Fool universe. That's the only place you'll find it. Again, the name is Five, spelled out Five. E, then the number 9, Five9 Incorporated. And what the company does is it virtualizes a company's customer call center. So we can all picture almost any company in the world has a customer service desk, and it's a bunch of people sitting there answering the phones. With Five9 software, which it sells on a subscription basis, you turn your call center into an online data center, basically, where you can answer your customers or interact with them through, yes, phone, but also messaging, social media, email, websites, and on and on. So it makes it much more efficient, much more cost effective, and maybe most importantly, it's a better customer experience that then drives sales.
And it's got the great software as a service model that we love. So many great emerging software companies that have set up the subscription model and put their solutions out in the cloud. What else do you like about Five9? Ticker symbol is FIVN on the NASDAQ.
So you mentioned earlier that we actually are looking for those 2X and 5Y companies, so companies that can double over the next 5 years. And I think this is one that has a good shot at doing that. So as Jeff mentioned, this is a SaaS-based, so software as a service, and they operate a subscription model where they charge a fee on a per seat basis. So by their estimation, there's about 15.8 million contact agents worldwide, and using their average revenue per seat, that would be about a total addressable market of about $24 billion. So a pretty large market there that they have, and not a ton of competitors, and they have a lot of strategic partnerships with a lot of big names. So I think this is one definitely I would like to watch.
Great growth rates, great retention rates, and anything that's using the cloud to make the client smarter, to turn a call center into a smart call center that has a lot more data and a lot more solutions that are available to those clients is something that we're interested in. They've got great financials too, Jeff.
Yeah, Tom, revenue is growing more than 20% annualized, lately much higher than that, and we think that can sustain for a long time. The company has been free cash flow positive since 2016, which is great for a company that's small. It still has a little bit less than a $2 billion market value at last look. And they're starting to turn profitable. Their losses have steadily shrunk. Now they're very small, 4-ish million in the past year. So they're on the cusp of turning profitable as well. And that's while, as Abby said, only about 10 to 15% of the customer service industry has gone digital so far or virtual. Most are still old school phone calls. So that's a lot of companies out there that need to change how they're serving their customers. And then finally, Five9, 94% of sales last year in 2017 were domestic. So they have a lot of international opportunity as well. So all the reasons we've stated, smallish company, growing rapidly, good financials, really good financials and potential, and a price that we think could double at least in the next 5 years.
It's funny, Chris, just to sort of reinforce the quality of the work that these two fools do. Again, a reminder that last time Abby brought a company forward for us to share. It's
Setting the bar very high.
It's done pretty darn well. I wouldn't say that we have that level of expectation, but yeah. When these two investors say a double in the next 5 years, which is our baseline goal for all of our Rising Stars companies, it feels very good to me. And Jeff, in another discovery service, the company that he was really advocating, is a little bit of a competitor on the fringe a little bit of Five9. That's a company called Twilio that Jeff has advocated strongly for, and it's generating great returns as well. And last thing I'll say, just as again, if you're not, whether you're going to join us or not in Rising Stars, we want you to be as smart as possible about the investment decisions you're making. And one thing to really recognize in the world we're in today is that these companies whose costs include nothing physical, no material costs. So there are really only three costs to these businesses: marketing, talent, and R&D costs. When you're focused on innovation, getting the best talent, and being able to market digitally online and build up a high retention business, the margins can be incredible. And if you get those growth rates humming, as Five9 has, you've really got some great long-term potential from these investments. So thank you, Abby and Jeff.
Of course, Tom, I'll add that Abby and I were happy to present one company, but it's just one, and it's so much more fun and so much more recommended to buy all the Rising Star stocks. And if that's 20 stocks or 30 or whatever you end up buying from our universe, treat it like an index of small caps. Own a little bit of each, because we really don't know which will end up being the big winners. And it's so much more fun to learn, as you've talked about, Tom, about each company with us along the way, and really feel secure in having a diversified portfolio.
Full agreement.
Before we wrap up, any final thoughts, Tom, on the Rising Stars portfolio, the final opening of the Rising Stars portfolio?
I'm just going to restate what we've said before, which is that there are 4,000 companies out there that have capitalization under $5 billion. It's very hard to cover all of them as an individual. When we started the Motley Fool, part of the reason we did is we love investing so much. Why not include a community? Why not use the online medium to bring people together to do that research? And we have hired people like Jeff right out of our community over the years because they've demonstrated awesome results. And you've got Abby here now with 3 years on our team, bringing great new ideas to the table that are helping us beat the market by more than, at least in my history, than I have. So it is the team dynamic, I think, in Rising Stars that helps us cover 4,000 companies and narrow down the list to not just the top 400, that would be 10%, not just the top 200, that would be 5%. No, the top 20. We're talking about the top 0.5% of the companies out there. These are our highest conviction small caps. And thank you both for making us smarter here in the period of time that you've been with us in Rising Stars. And we're very excited about the year and years to come.
Thank you all so much for watching. We know your time is valuable. We appreciate your spending time with us. Again, click the button below the video. All the value proposition that we laid out earlier, I'm not going to repeat it. You already know it, but go ahead and click the button below, and please join us for the final opening of the Rising Stars portfolio. Thanks again for watching, and Fool on.
Full on.